Okay, let's take a look at this comprehensive standard cost variance problem. It's problem 9-20A, and I'll read it to you. Luke Corporation uses a standard cost system and sets predetermined overhead rates on the basis of direct labor hours. The following data are taken from the company's budget for the current year. And you see that we've got 65,000 of denominator activity. It looks like they're using direct labor hours for that. Variable manufacturing overhead costs are $143,000. Fixed manufacturing overhead costs are $341,250. And now, continuing with the reading of the problem, the standard cost card for the company's only product is given below. So we've got direct materials at $31.20, and that's 4 yards at $70.80 per yard. Direct labor takes 4 direct labor hours at $8.40 per direct labor hour. That comes out to be $33.60 per unit, right? Manufacturing overhead, 4 direct labor hours at $7.45 per DLH. That comes out to $29.80. And when we add the direct material, the direct labor, and the manufacturing overhead together, we come up with a standard cost per unit of $94.60. All right, during the year, the company produced 17,100 units of product, and they incurred the cost below. And let me slide a little bit so you can see that. All right, materials purchased, 69,200 yards at $8 for $553,600. Material used in production, 69,000. Direct labor cost, it looks like 66,500 direct labor hours were used at $8.60 per direct labor hour. Variable manufacturing overhead cost incurred $141,800, and that would have come from the company's general ledger. And the fixed manufacturing overhead, also coming from the company's general ledger, would be $345,700. Okay, now I've slid down the screen a little bit so you can see requirement 1. It says redo the standard cost card in a clearer, more usable format by detailing the variable and fixed overhead cost elements. And you see I have the answers in front of you. Direct materials, $31.20. Direct labor, $33.60. $8.80 for variable manufacturing overhead, and fixed manufacturing cost of $21 for a total standard cost per unit of $94.60. All right, well, let's go through the calculations of how I came up with that. What I'm going to do is slide some hints right on the screen, right there. Okay, so right there on the screen I've put how we came up with that. So the 3120 was derived by taking 4 yards at $7.80 per yard. We multiply that across, you get 3120. Direct labor, we take the 4 direct labor hours at $8.40, the standard rate per direct labor hour. That gets us the 3360. Variable manufacturing overhead was 4 direct labor hours at $2.20 per direct labor hour, which gets us $8.80. Well, where did the 220 come from? We took the 143,000, that was the variable manufacturing overhead, we divided it by the 65,000 direct labor hours, and that's how we came up with the $2.20 variable manufacturing overhead rate per direct labor hour. Then for fixed manufacturing overhead, we've got the 4 direct labor hours at $5.25, and again, the $5.25 calculation to the left of my mouse here, we took the 341,000 of fixed manufacturing overhead, divided it by the 65,000 direct labor hours, and that comes up with $5.25 per direct labor hour. When we multiply the 4 direct labor hours times the 525, we come up with $21 as the fixed manufacturing overhead. So then we add up all of those components, we come up with a standard cost per unit of $94.60. Okay, now I've moved the screen a little bit again on you, and now you see requirement 2, which says compute the variance for materials for the year. And the price variance is unfavorable, $13,840. The materials quantity variance is unfavorable, $4,680. Okay, so how do we come up with that? Let me slide over the material variances. I'll put it right here in front of us. Okay, so now we've got it right in this area here. Well, how do we come up with the $13,840? Remember that the materials price variance is equal to the actual quantity times the difference between the actual price and the standard price. So we used 69,200 yards. The actual price was $8 per yard. The standard price is $7.80. That's a difference of 20 cents. 20 cents times the 69,200 yards gives us 13,840. Since the actual cost per yard was higher than the standard cost per yard, the variance is unfavorable. Now, to calculate materials price variance, we take the standard price times the difference between the actual quantity and the standard quantity. So now we take the $7.80 per yard, that's the standard price, and we take the difference between the 69,000 actual quantity yards versus the 68,400 standard quantity yards. And how we derive that is we would take the 17,100 units we made times 4 yards per unit, and that comes up with 68,400. Okay? So we need to sort of solve these piecemeal before we can come up with the final answer, and we get 4,680 when we work through those calculations. Okay, then on part B, it says compute the variance for labor for the year. And let me move this one over, and I'll show you how those labor variance come into play. I'll put the labor variance right there on the screen so you see it. We compute the labor rate variance at 13,300. Well, how did we get that? We take the actual hours, right above my mouse, times the difference between the actual rate and the standard rate. So 66,500 direct labor hours were incurred. The actual rate was $8.60. The standard rate was $8.40, so we're unfavorable. We know we're 20 cents higher. And when we multiply that 20 cents times 66,400, we come up with 13,300 unfavorable, which is that number right there. Then to compute the 15,960, following my mouse, we take the standard rate times the difference between the actual hours and the standard hours. So the standard rate was $8.40 per direct labor hour. The actual hours were the 66,500, right? We work with that there. But the direct labor hours at standard should have been 68,400. Well, how did we calculate that? We made 17,100 units times 4 direct labor hours, which gives us the 68,400. So we were actually favorable, right? We only used 66,500 hours. We were expected to use 68,400 based on the standard. So the difference in those hours times the 840 amount gets us 15,960. Okay, I've moved the screen again, and now we have requirement 3 right in here, which says compute the variance for variable overhead for the year. In variable overhead, spending variance was 4,500. The efficiency variance was 4,180. How do I get that? Let's just move the answers right here again. I'll put it over part of what we've already worked. The variable overhead spending variance is equal to the actual hours times the actual rate minus the actual hours times the standard rate. So another way of saying that is it's the actual hours times the difference between the actual rate and the standard rate, right? You can rearrange the terms to get that. So we know that variable overhead was given as 141,800. Then we need to subtract off the 66,500 direct labor hours times the 220 per direct labor hour, right? That gives us our standard component, and we wind up with 4,500 of a favorable variance. And it's favorable because the actual hours was less than the standard amount. Okay, then the variable overhead efficiency variance, we would take the standard rate times the difference between actual hours and standard hours. So we take the 220 standard times the difference between the 66,500 direct labor hours and the 68,400 direct labor hours. It's standard. And again, 66.5 is less than 68.4, so we're favorable. We compute those hours, multiply it times the standard rate. We come up with 4,180, and that's how we get that number right there. Then we need to compute the variance for fixed overhead. I'm just going to put this right on top, and we'll take a look at that. Okay, so fixed overhead variance, the budget variance is the actual fixed overhead cost minus the budgeted fixed overhead cost. They gave us actual fixed overhead at $345,700. The budgeted fixed overhead cost was $341,250, so we've got a unfavorable variance of $4,450. The volume variance is equal to the fixed portion of the predetermined overhead rate, which is denominated hours minus standard hours allowed. So we take the $5.25 per direct labor hour times the 65,000 direct labor hours versus the 68,400 direct labor hours at standard. Now we're favorable here. So since 65,000 direct labor hours was less than the 68,400 direct labor hours at standard, we multiply that times the 525, that predetermined fixed overhead rate we already calculated, and we come up with 17,850. And that gives us our fixed overhead volume variance. Okay, and then finally on Part 4 it says, what effect, if any, does the choice of the denominator activity level have on the unit standard cost? And it says, does it result in a higher standard cost or a lower standard unit cost? And we're going to say the lower standard unit cost is the correct answer. And when we read the description of that answer, it's the choice of a denominator activity level affects standard unit cost, and that the higher the denominator activity level chosen, the lower the standard cost will be. And that's because the fixed portion of overhead cost remains the same, right? But it's spread out over more units. So anytime we take a numerator and divide it by a larger denominator, the answer we get is a smaller result. Okay, and that's why we wind up with lower standard unit costs. Then on Part B it says, is the volume variance a controllable variance from spending point of view? And the answer is no. The volume variance can't be controlled by controlling spending. It's simply the result of whether actual activity was greater than or less than the denominator activity, or the predetermined budget level activities, another way of thinking about that. Thus the volume variance is controllable only through the activity. It's not a function of controlling your spending. And that takes care of this problem, everyone.